Hi guys, welcome to our second video in our Smart Start series, covering your bases. In the first video we discussed the three most important things to get started with and the first type of insurance that you're considering, which is your disability protection. In this video we're going to talk about covering your bases. Now there's two things that I refer to when I mean covering your bases, and that's basically your responsibilities to others. The first one is your responsibility to your dependents. Now, dependents are anyone that is dependent on you financially. This could be, and normally is, firstly your spouse and your children, but often there are also elderly parents that might be living with you, or parents-in-law, or anyone else that you are supporting. If you pass away, more often than not, as the breadwinner, there will be serious financial difficulty in your home if that income is lost. The second thing that I refer to is the obligation towards your debtors. That is normally the bank or a financing institution. If these debts do not disappear at your death, your estate remains responsible for them. Now, indirectly, it is actually protecting your dependents once again, because whatever your estate has to pay to your creditors gets deducted from that which is available for your dependents at your death. If you owe more than what your estate is worth, your dependents actually get nothing at the end of the day. And quite possibly, depending on how you are married, they can actually be in a worse position being indebted afterwards. So what I'm talking about covering is, number one, make sure that you have at least a death income policy. A death income policy basically being a type of pension fund or a type of pension policy. It's not really a pension fund, but it is a monthly income that will pay to your spouse or to your children for a set period of time. Now, normally what I recommend is that you consider leaving an income that would at least cover your children for the first 20 years of their life. In other words, to at least get them through schooling or possibly varsity. The second thing that you then can consider is leaving an income for your spouse, depending on how young you are at this point in time. You might want to do it for only a 20-year period, because that is enough of a time for someone to recover and stabilize themselves financially. It can even be as little as a 10-year period, especially if you're very young. It is likely to remarry. Not a nice thought, but it is a reality in life. If you are older, however, and there are these needs, and you have not made enough provision through pension to look after your surviving spouse, you might need to consider death income as an option for the lifetime expectancy of your spouse. So look after your dependents' income. The second thing, in terms of obligations towards debtors, is basically making sure that there is lump sum cover. This is insurance that pays out in one bulk lump sum instead of in a monthly income amount like the death income example. This type of insurance can be death lump sum and disability lump sum cover. This will make sure that if you become disabled and are unable to work, at least you don't have the burden of having to pay off your house or pay off your car or pay off your credit card or your private loan. All these things can be put in place so that you are debt-free or your family is debt-free in one of these insurable events, death or disability. Cover your bases, make sure your dependents are looked after. Thank you.